So, hello everyone. I trust that you are well. Welcome to yet another learning session. We continue learning more on treasury bonds. On a previous video, I just made an introduction of what treasury bonds are. In this clip, I wish to dive in and give the key features of a treasury bond, that those features that I think it is essential that you understand before you get to invest in the treasury bonds. And for the purpose of a better understanding, I believe using an example will make the understanding a little bit easier. I believe the same way that if you are given a formula, it will only make sense when you are given an example. So when explaining the key features, I used to use an example of a treasury board, which has already been issued, and I would wish to use the very latest issued treasury bonds. I think it is only treasury bonds that has been issued in the year 2024. So our case study will be based on the IFB stroke 2024 stroke 8.5. That is the title of the treasury board. So every treasury board has what we can call maybe an offer letter, where you get the entire information regarding that treasury board. So if you Google IFB stroke 2024 stroke 8.5, you'll be able to get that letter that entail every detail about a treasury board. So this infrastructure board of 2024, it is a treasury board where the Republic of Kenya intended to borrow 70 billion from Kenyans, money that was purposed to fund infrastructure project in the financial year 2023-2024. So it is a bond issued by the government of Kenya, and the intention was to raise 70 billion from the members of the public. That is the case study that we are going to use as we try to understand the key features of a treasury bond. The first feature that you need to understand on matters treasury bond, it is the minimum amount that you can be able to invest. So each and every treasury bond has a set minimum amount that an investor can be able to invest. For this particular bond that we are discussing, the minimum amount was set at 50,000. So you cannot invest 49,000. The minimum amount that you could be able to invest was 50,000. Then any other 50,000, it should be a multiple of 50,000. So it is 50,000, 100,000, 150,000, 250,000, exactly. So a minimum of 50,000, and any additional amount should be a multiple of 50,000. The second feature that is important noting, it is the interest, because actually that's why we are investing, to get some interest in return. So every bond has a given interest rate, which is in percentage. For this particular bond that we are using as an example, the rate was at 18.4607% per annum, meaning you get a return of 18.4607% of the amount you invested every year. So treasury bonds pay interest twice in a year. So let's take an example of an investor who invested 100,000. So if you do your math, the interest from 100,000 comes to 18,460 and 70 cents. So that is the interest per annum, but the interest is paid twice in a year. So it is that interest of 18,460.7 cents that you divide by 2 to get 9,230 and 35 cents. So the investor will get 9,230 and 35 cents 2 times in 1 year. And it is important noting that treasury bonds pay interest on some predetermined dates that are even included in that bond offer. So it is well written on the day on which investors receive their interest. So for this particular bond, the bond was issued on February, meaning after 6 months, that's when the investors should receive their first interest payment or coupon payment. So on 19th of August, that's when they will receive the first. Okay, for the example of an investor who invested 100,000 on 19th of August 2024, the investor will receive 9,230 and 35 cents. Then 6 months later, that is on the 17th of February 2025, the investor will then receive another 9,230 and 35 cents. So it is that annual interest that is divided and paid out into installments. Another key thing that is worth noting is the maturity of a bond, and that can be defined as a time for which the bond will run. So each and every bond has a given maturity time. For this particular bond that we are discussing, the maturity time is 8.5 years, meaning the bond will mature after 8.5 years. But it is good to note that not all investors will have their money held by the government for the 8.5 years. Maturity of a bond. So another key feature of a treasury bond that is worth noting, which I think it is among the most important, is the redemption structure, because this is part of the terms that determines or indicates when investors will get back their principal amount. So it's very crucial. It explains when you'll be able to get back your principal amount. So each and every treasury bond has a given redemption structure that is clearly outlined on the bond offer letter. So back to our example, the IFB stroke 2024 stroke 8.5, the first principal payment will be done after 3 years. That is on the 15th of February 2027. So on the 15th of February 2027, every investor who had invested for an amount between 50,000 and 1 million, they will get back 100% of their principal amount. So in fact, for them, it is not an 8.5 years bond, it is a 3 years bond, because they will get back their principal amount after 3 years. And this means that they will stop getting interest after 3 years. So for investors that invest an amount less than 1 million, it means for them it is a 3 years bond. Then on the same date, 15th of February 2027, investors who had invested more than 1 million, they will just get 20% of their principal amount. This means they will continue getting interest on the remaining amount of their principal amount. Then, after another 3 years, that is the 11th of February 2030, the investors will get 30% of the remaining amount. So they will continue getting interest on the remaining principal amount. Then, after another 2.5 years, that is on the 9th of August 2034, the investors will get 100% of their principal amount, and that means they stop getting interest because the bond will have matured. So it is an 8.5 years bond for investors who had invested 1 million and above. But for all those investors who had invested less than 1 million, it is basically a 3 years bond. The redemption structure of a bond is an important feature to note because you should be able to plan your cash flows well, because you don't use money that you'll need in some few months to buy a bond, because it might be a bit hard or might take you to losses when you try to immediately sell the bond in the secondary market. You might not be able to sell it at the same price that you bought the bond at. So it is good to consider your cash flows so that you get engaged into that bond that favors your cash flows. And still on the redemption structure, it is worth mentioning that treasury bonds can be used as securities for credit facilities, that is loans. You can use your treasury bond as a security for a loan. And during the redemption structure, if you have used your treasury bond as a security for a loan, you will not be paid your principal amount until the final maturity date, because the term of the treasury bond indicates that they pay an encumbered amount, that is those amounts that have not been used as security for loans. So if you use your treasury bond as a security for a credit facility, you have to wait until maturity to get your principal amount back. Taxation is also a critical issue to note as far as treasury bonds are concerned. It is worth noting that any interest you earn in any investment vehicle, it is subject to withholding tax, which currently stands at 15%. So any interest you earn, you need to pay a withholding tax of 15%. But for the case we are using, for the example of the bond that we are using, it is an infrastructure bond. And one of the special features about infrastructure bonds is that they are tax free. So you don't pay tax for an infrastructure bond. But if it was just an ordinary bond, it would be subject to a withholding tax of 15%. So assuming the same rate and the same principal amount of 100,000, our interest was coming to around 18,460.70 cents. So 15% of that, which is around 2,767, would be deducted as withholding tax. But for the infrastructure board, they are tax free, so you don't pay any tax. But other than that, any interest you earn on other investment vehicles are subject to withholding tax, which currently starts at 15%. So I think those are the basic features that you need to understand before diving into investing in treasury bonds. So feel free to drop that feature that maybe I left out in the comment section. Also, you are free to ask that question that maybe you did not understand well, and stay around and check out for other videos that will be coming soon as we discuss more on treasury boards and other investment features. We should discuss on the risk that is involved in treasury boards, if any. We should also discuss on the how part to invest on treasury bonds. So keep hanging around and checking out for new videos. Until next time, keep learning.